Hi, welcome to Money Mastery Minds. Today, we're diving deep into the world of money, talking about the 4 fundamental rules of financial literacy that I believe everyone needs to know. These are the rules that can make or break your financial future. And trust me, they are way more important than whatever trendy investment everyone's talking about this week. From drowning in debt to living paycheck to paycheck, it's not pretty. But the good news is, it doesn't have to be that way. By understanding these 4 basic rules, you can take control of your finances, build a secure future, and achieve your financial goals. So, buckle up, grab a pen and paper, because we're about to break down these rules, step by step, in a way that's easy to understand and even easier to apply to your own life. The first rule, and arguably the most important one, is understanding how money actually works. Without this foundational knowledge, managing your finances effectively becomes a daunting task. It's not enough to just know how to earn money. You need to understand how to make your money work for you. This involves strategic planning and smart investments. This starts with grasping the fundamental concepts of income, expenses, assets, and liabilities. Let's start with income, the cornerstone of your financial health. This is the money you earn from your job, your business, or any other source of revenue. It's the fuel that powers your financial engine. It's the lifeblood of your finances, and without it, well, you're not going to get very far. Ensuring a steady and reliable income stream is crucial. Next up, we have expenses. These are the outflows of money that you need to manage carefully. These are the costs you incur in your day-to-day life and can be further divided into 2 categories: fixed expenses and variable expenses. Understanding these can help you budget more effectively. Fixed expenses are those that stay relatively the same each month, like your rent or mortgage payments, car payments, and insurance premiums. These are predictable and easier to plan for. Variable expenses, on the other hand, fluctuate from month to month, such as groceries, entertainment, and transportation costs. These require more careful monitoring. Now, let's talk about assets and liabilities. These are critical components of your financial picture. An asset is anything that puts money in your pocket. It's something that appreciates in value or generates income. Think of it as something that works for you, even while you sleep. Assets are your financial allies. This could be a rental property that generates passive income, a stock portfolio that appreciates in value, or even a high-yield savings account that earns you interest. Diversifying your assets is key. Liabilities, on the other hand, are the opposite of assets. They represent financial obligations that you must pay off. They take money out of your pocket. Managing liabilities is crucial to maintaining financial health. This could be your mortgage, your car loan, student loans, credit card debt, or any other form of debt you might have. Reducing liabilities can free up more money for investments. The bigger your liabilities, the harder your money has to work just to keep up. It's a constant balancing act. Understanding the difference between assets and liabilities is crucial because it highlights the importance of building wealth through assets that generate income, rather than accumulating liabilities that drain your finances. This knowledge empowers you to make smarter financial decisions. And that brings us to the concept of cash flow. This is the lifeline of your financial health. Cash flow is the movement of money in and out of your accounts. It's a dynamic process that needs constant attention. A positive cash flow means you have more money coming in than going out, while a negative cash flow means the opposite. Striving for a positive cash flow is essential for financial stability and growth. Alright, so now that we've covered the basics of how money works, let's move on to rule number 2, which is all about mastering the art of budgeting and saving. Think of your budget as a roadmap for your money. It helps you track where your money is going, identify areas where you can cut back on unnecessary expenses, and allocate your income towards your financial goals. Without a budget, it's easy to overspend, lose track of your finances, and fall short of your goals. Now, there are countless budgeting methods out there, but one of the simplest and most effective is the 50-30-20 rule. This rule suggests dividing your after-tax income into 3 main categories: 50% for needs, 30% for wants, and 20% for savings and debt repayment. Your needs should make up the largest chunk of your budget, encompassing essential expenses like housing, transportation, groceries, and utilities. Wants, on the other hand, are non-essential expenses that bring you joy and improve your quality of life, such as dining out, entertainment, hobbies, and travel. The remaining 20% of your income should be dedicated to savings and debt repayment. Speaking of emergency funds, let's talk about the importance of having a financial safety net. Aim to save at least 3 to 6 months' worth of living expenses in your emergency fund, gradually building it up over time. Rule number 3. Invest wisely and grow wealth. This is where things start to get really exciting, because investing is one of the most powerful tools you have at your disposal to build long-term wealth and achieve financial freedom. It's like planting a seed today and watching it grow into a mighty tree over the years. Now, I know investing can seem intimidating, especially if you're new to the game. The sheer amount of information and options can be overwhelming. But trust me, it's not as complicated as it may seem. With the right guidance and a bit of patience, anyone can become a successful investor. The key is to start early, stay consistent, and invest for the long haul. This means making regular contributions to your investment accounts and not getting discouraged by short-term market fluctuations. The earlier you start investing, the more time your money has to grow, thanks to the power of compound interest. It's like giving your money a head start in a marathon. Compound interest is essentially the snowball effect of earning interest on your initial investment, as well as on the accumulated interest from previous periods. Over time, this can lead to significant growth. In simpler terms, it's like earning interest on your interest, which can lead to exponential growth over time. The longer you let it work, the more powerful it becomes. So, even if you can only invest a small amount each month, starting early and staying consistent can make a world of difference in the long run. Every little bit adds up. Now, let's talk about some different investment options you can consider. Diversifying your investments is crucial to managing risk and maximizing returns. One popular option is investing in the stock market. This can be done through individual stocks, mutual funds, or exchange-traded funds, ETFs. Stocks represent ownership in publicly traded companies, and when you buy stock in a company, you're essentially buying a small piece of that company. This can be a rewarding way to participate in the growth of businesses you believe in. Investing in stocks can be a great way to grow your wealth over time, as the stock market tends to increase in value over the long term. Historically, it has provided higher returns compared to other asset classes. However, it's important to remember that investing in the stock market does come with risks, and the value of your investments can fluctuate in the short term. It's essential to stay informed and be prepared for volatility. Another popular investment option is real estate. This can provide both income and appreciation over time. Real estate investing involves buying, owning, managing, renting, or selling real estate for profit. It can be a tangible and rewarding way to build wealth. This could include anything from purchasing rental properties to flipping houses to investing in commercial real estate. Each type has its own set of benefits and challenges. Real estate can be a great way to generate passive income, build equity, and diversify your investment portfolio. It can also provide tax advantages and a hedge against inflation. However, it's important to do your research, understand the local market, and be prepared to put in the time and effort required to manage your properties effectively. Real estate investing is not entirely hands-off. Building multiple streams of passive income is essential for achieving financial freedom, as it allows you to generate income without being tied to a traditional job. This can give you the flexibility to pursue your passions and enjoy life on your own terms. Rule number 4. Manage debt and credit responsibly. Debt is a fact of life for many people, and when used wisely, it can actually be a valuable tool for achieving your financial goals. It can help you make significant investments that you might not be able to afford up front. However, it's crucial to understand the difference between good debt and bad debt, and to manage your debt levels carefully to avoid falling into a debt trap. Knowing this distinction can save you from financial stress. Good debt is debt that helps you build wealth or improve your financial situation over time. It is an investment in your future. This could include a mortgage on a rental property that generates passive income, providing you with a steady cash flow. A student loan that allows you to pursue higher education and increase your earning potential is another example of good debt. Or a business loan that helps you start or grow a profitable venture, enabling you to expand your business operations. Bad debt, on the other hand, is debt that doesn't provide any real financial benefit and can actually harm your financial health in the long run. It often comes with high interest rates and unfavorable terms. This could include high-interest credit card debt, payday loans, which can quickly spiral out of control, or personal loans taken out for discretionary spending, such as vacations or luxury items. Managing debt effectively involves understanding the terms of your loans, making your payments on time, and minimizing the amount of interest you pay over the life of the loan. This requires careful planning and discipline. One effective strategy for managing debt is to prioritize paying down high-interest debt first, such as credit card debt, to reduce the overall interest burden, while making minimum payments on lower-interest debt, such as student loans, to keep them in good standing. To improve your credit score, focus on making all your payments on time, as this is one of the most significant factors in your credit rating. Keeping your credit utilization low, ideally below 30% of your available credit, is also crucial. Avoiding opening too many new credit accounts in a short period can prevent unnecessary hard inquiries on your credit report, and regularly checking your credit report for errors can help you catch and correct mistakes that could negatively impact your score. Remember, managing debt and credit responsibly is crucial for maintaining a healthy financial profile and achieving your long-term financial goals. It sets the foundation for financial stability and success. So there you have it, the 4 fundamental rules of financial literacy that can empower you to take control of your finances, build a secure future, and achieve your financial dreams. Remember, financial literacy is a journey, not a destination. Whether you're just starting out on your financial journey or looking to level up your money management skills, these 4 rules will serve as a solid foundation for making informed financial decisions and creating a brighter financial future. If you found this video helpful, don't forget to give it a thumbs up, subscribe to my channel for more financial tips and tricks, and hit that notification bell so you don't miss any future uploads.